The road to success and riches is full of opportunities, successes, and failures. You might think it impossible, but the right investment alongside your 9-to-5 job can make you a millionaire. Want some motivation? Well, I have a success story for you. At the age of 43, Tom retired from his 9-to-5 job at Ford Motor from a combined effort of savings and stock market investments. Tom graduated from the University of Michigan, Dearborn, at the age of 23. The day he graduated from college, he did not have a penny to his name. So how did he make the lofty sum of $1 million in 20 years? Well, that's the story, my friend. Welcome to Wealthy Pace, the source of inspiration for future billionaires. I am really happy to see that you are here for today's amazing success story, and I hope you will enjoy it. So let's dive right into it without wasting any time. But before that, make sure you are subscribed if you didn't subscribe yet. Let's begin. Like his father, Tom had a degree in mechanical engineering. He had landed a job at General Motors, but Tom always felt he wanted something different from what his peers expected from life. During the first few weeks at General Motors, if anything, this feeling was strengthened. Tom met with his supervisor, James, who had been in the company for a very long time. All Tom could think was, wow, he is still at the same place, doing the same thing that he was doing when he was my age. So Tom took the alternative strategy. This video will show you 3 stages that Tom went through to reach his final goal of financial independence. You will see that different things are important at different stages, but you have to note one thing from the get-go. If Tom had not been investing, had he tried to reach his magic number of $1 million by only relying on his paycheck from the engineering job, he would have shared this tale by the age of 57 instead of 43. By investment, Tom earned 14 years of the most significant currency in life, which is time. You will learn what Tom focused on as a stock market investor, what he focused on outside the world of investing, and perhaps most importantly, what he did not do. So let's jump into the 3 stages that Tom got through to make $1 million. First stage, how Tom went from $0 to $20,000. So this is really the getting started stage. Many of you would already have reached this stage and beyond. Well, in that case, well done. Sit tight though, I will soon be at your current stage. During a day at the library, Tom had been asked to pick up 1984 for his mother in quarantine. He stumbled over a copy of The Richest Man in Babylon. Yes, he literally stumbled. While eyeing a cute red-headed clerk, he did not watch his step and scattered books all over the floor. The backside of The Richest Man in Babylon read, "An assured road to happiness and prosperity." Maybe this was just what he needed. Tom borrowed the book. The red-headed girl was still giggling over his clumsiness. How embarrassing. She was even more adorable up this close. Tom hoped he would meet her again. The book that Tom borrowed preached, "Pay yourself first." The book advocated that Tom should pay himself 10% of his salary each month before doing anything else with his money. Clearly, this was what his supervisor, James, was missing. He did not pay himself first. In fact, he paid American Airlines, Night Force, and Sitka first. The more Tom got to know James, he discovered James did not pay himself at all. Not that it is a bad thing, it just did not seem to be a good recipe to become independent from one's paycheck. So this is exactly the right thing to do during the first stage. Pay yourself first. The stock market is an excellent way of making a decent chunk of money into a massive chunk of money. However, it is not ideal for only enlarging a tiny piece of money. This early on your road to financial freedom, you should deal with the stock market as you would with a Swedish smorgasbord. Have some eggs, a few meatballs, and maybe some herring. Well, you cannot theorize your way to what a meatball tastes like. You need to eat one. It is similar to stock market investments. If someone suggests you invest without real money on some simulator or something, tell them, do your best to steer clear of fermented fish though. Tom learned this the hard way. After reading The Richest Man in Babylon, he went on to Robert Kiyosaki's book, Rich Dad, Poor Dad. He was pretty disappointed that he did not bump into the pretty red-headed in the library, but at least he learned that a stock market is an excellent place where savings can be converted into assets. He soon found himself reading various speculative tips on different biotech companies on Reddit. He made a good profit at first. $5,000 was converted into $1,000 in just a week. But before long, he experienced what could be expected from this approach. The little capital he had went down by 60%. Tom fell from the peak mount of stupid into the valley of despair. But Tom knew about Warren Buffett's golden rule: to never lose money. Actually, he was lucky to learn Buffett's rule number 2 as well. To never forget rule number 1. Tom replaced his loss within 2 months thanks to his salary. So you know what Tom did after that? He began to learn how the stock market game worked. Within 2 years, Tom managed to go from $0 to $20,000 by saving $1,000 from his paycheck every month working as a junior engineer at General Motors, losing something like $2,000 by investing in unprofitable nano-biotech companies, and losing $1,000 in brokerage commissions. Yes, Tom was trading a lot in the beginning. It was the savings that carried the whole way. Stage 2. How Tom went from $20,000 to $100,000. When Tom began his 3rd year of working at General Motors, his father wanted to have the talk with him. No, not that talk you are thinking about. His father offered to chip another $10,000 in his savings to help him buy a new house. But Tom knew this is a trap. Tom unknowingly acted on Charlie Munger's advice. The first rule of compounding is to never interrupt it unnecessarily. Luckily, Tom knew about Kiyosaki's advice. The house is a liability. You want to build assets. If you feel like you have as many resources as Tom did, do not celebrate too early and steer clear from buying a new car or paying a down payment for a house. You do not want to hinder the effects of compounding now that it is just starting to catch some speed. Now, because Tom had learned a hard lesson from the unprofitable nano-biotech companies, he now only invested in what he understood and could perform a back-of-the-envelope DCF on. One day, he was heading to the library again to pick up a copy of The Most Important Thing by Howard Marks. This time, he did not fall once but twice. First, on the redhead girl, and second, for the redhead girl. Eventually, he asked the girl Sarah on a date. They immediately hit it off. The good thing was, they had a shared interest in budgeting and finance. When they moved in together, Tom started sharing the rent of the house, which further helped him in his savings. Moreover, Tom had a raise in his salary since he was no longer a junior engineer. Also, he made quite average stock market returns of 10% per year. Together, this turned him into an owner of $100,000 on his 29th birthday. Take Charlie Munger's advice on this one. First, $100,000 is a bitch, but you gotta do it. I do not care what you have to do. If it means walking everywhere and not eating anything that was not purchased with a coupon, find a way to get your hands on $100,000. After that, you can ease off the gas a little bit. Stage 3. How did Tom zigzag from $100,000 to $1 million? While everyone at work seemed to be one-upping each other with their cars, their clothes, and their diner reservations showing no signs of frugality at all, Sarah and Tom took the alternative approach. Well, I am not saying that spending on yourself is wrong, but make sure you understand the opportunity cost of your decisions. Once you open the gate of your stock market to get a chunk of money out, will you be able to close it again? Do not underestimate the power of habits. Tom decided to ignore the extravagant lifestyle of his peers and decided to stay true to his goals. A part of Tom wanted to show off the colleagues of his extraordinary $100,000 portfolio. But then he remembered something he listened to in a YouTube video about wealth that you don't see. When you see someone driving around in their Lamborghini, realize that you are also seeing someone who is a Lamborghini poorer. So is it worth it? Perhaps not. Tom liked the video for the YouTube algorithm, a role model for us all. Right before Tom turned 31, the stock market crashed. The S&P 500 fell by more than 50% over the course of the year. Technically, this meant that Tom was back at stage 2 since his portfolio was now less than $100,000. But Tom did not fret. He had been mentally prepared for this moment. Tom realized that this was the time to pick up the exceptional companies that pessimists could not get rid of quickly enough. While he usually made something north of 8% per year in the markets, he made 30% and 45% respectively in the years following the crash. By the age of 33, Tom's portfolio was contributing more towards his savings each year than his salary was, still with quite average stock market returns of 10%. Both Sarah and Tom now bought a house since they felt like their 2-year-old daughter should live in a house, as both of them did. The down payment was $60,000, which he and Sarah split as they were married now. $30,000 was a setback for Tom's compounding machine, but he remembered that even Warren Buffett spent 10% of his net worth on a house back in 1958. When Tom turned 35, he switched from General Motors to Ford Motors as he was offered a 20% pay raise for the same working hours. Even with this salary, his portfolio vastly outnumbered his salary during some months in this period. Meanwhile, Tom made another contrarian decision as well. While his other colleagues were working extra hours in the office, Tom dedicated those hours to beat the stock market instead. And it paid off. Tom became one of those investors who beat the market every year. A performance of 4% per year suddenly meant something like $25,000 more in his pocket than the average investor with the same amount of capital would have been able to get. The hourly wage from studying the stock market was now really lucrative, and it kept improving. Tom, meanwhile, also created a small-scale wedding photography firm, a hobby he had long wanted to adopt. This was something that could further help him once he finally decides to quit his job. Stage 4. Tom's financial freedom. Before his 43rd birthday, Tom reached the lofty goal of $1 million and decided to quit his 9-to-5 job to live off his investments. More than half of this money came from stock market returns. This investment helped him reach his goal 14 years earlier than his salary alone would have done. Since Tom has now achieved financial freedom, he spends his time doing what he loves, which is investing in the stock market and spending time with his family. Well, if Tom can make his way to financial freedom, so can you. Want to learn more about the way or steps to your financial freedom? Proceed to this video. Hope you enjoyed today's video. So don't forget to hit the like button for more similar videos. Thank you.